Hi, I'm Jack Macfarlane. I'm a principal in the capital formation group at H.I.G Capital. H.I.G Capital is a 56 billion AUM alternative asset manager focused on the middle market. We invest across private equity, private credit, and real estate and infrastructure with a focus on middle market investing with smaller fund sizes and focusing on smaller deals. H.I.G has been investing in private equity since 1993, private credit since 2004, real estate since 2007, and private infrastructure since 2019. So I'd like to speak with you today about middle market value add infrastructure and how H.I.G thinks about it relative to other areas of infrastructure investing. We define middle market infrastructure as gross asset values of less than $500 million, requiring equity tickets of $50 to $250 million per deal. We see that there typically are 5 different categories in which these middle market infrastructure deals typically fall. The first is businesses or assets that are family or independently owned that would benefit from a value add growth profile, whether that comes from M&A, organic growth by expanding into new territories, or through institutionalization of processes or staff. And we feel that having a private equity background that H.I.G has is an important part, can play an important part in the growth of those assets and businesses. The second is the development of and the construction of assets and pipelines to create new essential infrastructure. And we see that most often in energy transition, with the development of renewable natural gas processing facilities, battery storage facilities, as well as also electrical vehicle charging. The third category is assets in need of repositioning or development as a result of either growth initiatives that the current owner wants to take, or deferred maintenance from prior owners, and needing to kind of take those physical assets to the next level. The fourth is in services. So we do focus on services that provide maintenance, inspection, installation, oversight of essential infrastructure assets. So where we see this most commonly is in telecommunication services, where we are providing inspection, maintenance, and installation of the cells that go on physical towers, and also in oil field services and energy services. And the fifth one is in emerging areas of infrastructure, where, and we see this most often in energy transition, as well as also in smart mobility services and student transportation as well. So we feel this is an opportune time to be investing in middle market infrastructure today. If you take a step back and look at the broad infrastructure market and what's going on in the macroeconomy today, we think that infrastructure as a whole is extremely well positioned due to the inflation protection of the assets and the contracted revenues. We believe that in a rising interest rate environment, we will see increased need for assets and for capital in middle market assets, as well as also repricing of middle market assets. In a recessionary environment, we feel that we are well positioned due to the fact that middle market assets tend to be smaller and less well capitalized. They're therefore needing capital from a partner to help them through a prolonged economic slowdown. Another reason we think that the time is right for middle market investing is there's less competition in the middle market relative to the large cap market today. If you look at the total amount of capital that has been raised for middle market strategies over the past 6 years, it only accounts for around 6% of total capital raised. Whereas if you look at total transaction volume, the middle market makes up 27% of transactions broadly across the infrastructure markets landscape. So we feel that delta is going to create a really unique opportunity going forward for middle market investing. Within the middle market, also, you have a ability to take a tailored approach to value creation by identifying specific risks and opportunities with the assets and businesses, and then an ability to put together a strategic business plan in order to map out how you want to add value to those assets, and then execute on that business plan in order to drive returns. And we think that the middle market is uniquely positioned for that type of approach. And then finally, the last thing we've seen with regard to market opportunity today is many formerly middle market GPs have moved upmarket to raise larger funds, thereby needing to deploy capital in larger assets, leaving a void in the middle market for firms today looking to employ that approach. So we don't think that investing in middle market value add infrastructure today is inherently more risky than your core or core plus strategy. If you take a step back and look at the returns that you're generating, those returns are being generated by business initiatives that you're taking at the asset level and at the business level, not by taking more risk. When you look at middle market infrastructure assets, they still have key infrastructure characteristics that provide downside protection and defensiveness. That is contracted revenues, recession resiliency, the ability to pass through costs to end users in an inflationary environment. And so we think that the returns that you're achieving in the middle market today are a result of specific value add initiatives that you're putting in place and then executing on those initiatives in order to drive returns. We tend to avoid assets that have the following characteristics: high technology exposure, deep cyclicality, as well as also the exposure to commodity prices, thereby allowing us to focus on high quality, cash flowing, defensive businesses that are in need of a value creation and business plan to either expand and grow and take the business to the next level, or execute on a plan to create new essential infrastructure assets, or to provide services to existing infrastructure assets, or to move into emerging areas of infrastructure.